Financial celebrities and their views on cryptocurrency reveal far more about their underlying philosophy of money power and trust than about the technology itself. And this is why their opinions often appear contradictory on the surface, while being internally consistent at a deeper level. When you listen carefully to what legendary investors, hedge fund titans, macro thinkers, and capital allocators say about crypto, you begin to see that they are not really debating coins, blockchains, or prices. They are debating the nature of value, the role of institutions, and the long arc of financial history filtered through their own experiences of cycles, bubbles, and systemic risk. Yet even among the most vocal skeptics, there is rarely outright dismissal. Financial celebrities who understand history recognize that every major shift in money from gold to paper currency to digital banking was initially met with ridicule and fear. What concerns them is not innovation, but the speed and leverage with which speculation attaches itself to innovation. When they warn about crypto, they are often warning about behavior rather than code leverage, disguised as liberation complexity, mistaken for genius and volatility, framed as inevitability instead of risk. On the other side, financial celebrities who express cautious optimism about cryptocurrency tend to frame it less as an asset and more as an experiment. They are intrigued by the idea of decentralized trust, programmable money, and systems that reduce reliance on centralized intermediaries. For these thinkers, crypto is not necessarily a replacement for existing financial systems, but a parallel system testing new rules. Their interest is philosophical as much as financial. They ask what happens when money becomes native to the internet, when settlement is instantaneous, and when ownership can be verified without authority. A common misconception is that positive voices among financial elites are all-in believers. In reality, most allocate mentally before they allocate capital. They separate the concept of blockchain utility from the valuation of individual tokens. They acknowledge that while the underlying technology may be transformative, most current implementations may not survive. This mirrors how early internet investors distinguished between the inevitability of the internet and the inevitability of any specific .com company. The lesson of that era weighs heavily on their thinking. Another critical factor shaping their views is control. Financial celebrities who have spent their lives navigating regulation, central banking, and geopolitical risk understand that money is inseparable from power. Cryptocurrency challenges that power structure, at least in theory. Some see this as a feature, others as a flaw. Those wary of crypto question whether states will ever fully relinquish monetary control, and if not, what that means for long-term adoption. They are less interested in ideology and more interested in who ultimately sets the rules when stress appears. Volatility is another dividing line. To many seasoned investors, extreme volatility is not a sign of opportunity, but of immaturity. Markets that can lose or gain half their value in short periods signal that price discovery is unstable and dominated by marginal emotion rather than deep capital. Financial celebrities who prioritize capital preservation see this as incompatible with serious wealth management. Others, however, interpret volatility as the natural state of an emerging asset class still searching for equilibrium. The disagreement here is not factual, but temporal. How long does immaturity last before it becomes disqualifying? Interestingly, even the harshest critics often concede one point: cryptocurrency has forced a global conversation about the weaknesses of the existing system. Inflation, monetary debasement, financial exclusion, and opacity have moved from abstract academic topics into public awareness. In this sense, crypto's greatest impact may not be its price performance, but its role as a mirror held up to traditional finance. Financial celebrities Regardless of stance, recognize that this shift in consciousness is not easily reversed. Their personal exposure, when it exists, is usually asymmetrical. Small relative allocations, venture-style thinking, and an acceptance that outcomes may be binary. This again reflects their deeper disciplined curiosity without recklessness. They are willing to explore, but not to bet their legacy on an unproven structure. This frustrates retail observers who crave certainty and conviction, but it is entirely consistent with how these individuals have survived multiple cycles. What becomes clear when you step back is that financial celebrities are not arguing about whether crypto will go up or down next year. They are debating where it fits, if at all, in the long-term architecture of money. Is it a store of value, a speculative instrument, a technological rail, or a social movement? The answer in their minds may change over time, and that willingness to let an opinion evolve is itself a hallmark of mastery. Perhaps the most telling commonality is restraint. Even those who are optimistic speak carefully. Even those who are critical leave room for surprise. This restraint comes from having seen too many inevitable narratives collapse and too many impossible ideas become reality. Financial celebrities have learned that the future rarely unfolds according to the loudest voices in the present, and it is precisely at this point where opinions stop being slogans and start revealing underlying beliefs about money trust and human behavior that the conversation becomes most interesting. Because understanding their views on cryptocurrency requires understanding not what they think about tokens, but how they think about systems, incentives, and cycles. And once you grasp that, you begin to see that crypto is less a verdict and more a lens through which financial masters are re-examining assumptions they once took for granted, assumptions about scarcity, authority, and value itself. And it is from this unfinished reflection suspended between skepticism and curiosity that we must continue, because what truly matters next is how these financial celebrities act on these views in practice, how they allocate, hedge, avoid, or engage, and how their behavior more than their words reveals what they actually believe. And it is exactly here, in this gap between stated opinion and real-world action, that the deeper truth begins to emerge as the sentence continues. And it is in this space between commentary and capital that the true position of financial celebrities on cryptocurrency becomes visible, because when words are stripped away and behavior is observed, patterns emerge that are far more instructive than interviews or headlines. Those who publicly criticize crypto rarely spend energy trying to suppress it. They simply ignore it operationally, choosing not to allocate meaningful capital because it does not fit their framework for durability, cash flow, or governance. Their skepticism is expressed through omission, not opposition, which is often misread as hostility when it is actually indifference grounded in principle. Meanwhile, those who express cautious openness tend to engage indirectly. Rather than buying large quantities of tokens, they invest in infrastructure exchanges, custody solutions, or adjacent technologies that benefit from adoption, regardless of which specific asset prevails. This approach mirrors how experienced capital approached the early internet, avoiding consumer-facing speculation while funding the picks and shovels that supported the ecosystem. Their behavior signals belief in optionality rather than conviction in any single outcome. Another revealing pattern is how they size exposure. When financial celebrities allocate to crypto, it is almost always in proportions that cannot damage the core portfolio if the thesis fails. This is not a lack of confidence, it is respect for uncertainty. They treat crypto as a venture-style bet inside a much larger, more stable system. Retail observers often misinterpret this as hypocrisy. If you believe, why not go all in? But this question itself exposes a misunderstanding of how experienced capital survives. Belief does not require concentration when uncertainty is high. Equally telling is how they react to extreme price movements. During euphoric rallies, financial celebrities rarely increase exposure. They become quieter, not louder. During crashes, they observe more than they act. This behavior reflects a deep suspicion of emotionally driven markets. They are not trying to time every move. They are trying to understand whether stress reveals structural strength or fragility. Volatility for them is diagnostic, not enticing. Regulation is another axis where behavior clarifies belief. Financial celebrities who engage with policymakers, regulators, and institutions do not frame crypto as an unstoppable revolution, but as a system that must eventually reconcile with law, taxation, and accountability. Their investments often assume that the future of crypto, if it exists at scale, will look far more regulated and institutional than early adopters imagine. This assumption alienates purists, but aligns with historical precedent. Systems that endure are those that integrate with power, not those that pretend power does not exist. There is also a generational dimension. Older financial masters shaped by inflationary cycles, credit crises, and institutional collapse tend to prioritize stability and proven frameworks. Younger financial celebrities, having grown up in a digital-first world, are more comfortable with abstract value and network-driven assets. Yet even here, the difference is less dramatic than portrayed. Both groups converge on caution, diversification, and learning without overcommitment. The caricature of generational war dissolves under closer examination. What ultimately unites these figures is not agreement, but discipline. Whether skeptical or curious, they resist absolutism. They avoid framing crypto as salvation or doom. This moderation is not indecision. It is an acknowledgement that early-stage systems evolve in unpredictable ways. Financial celebrities have learned that the most dangerous stance is certainty, especially in domains where technology regulation and human behavior intersect explosively. Over time, their views also evolve. Those who once dismissed crypto entirely may revise their stance as infrastructure improves or use cases stabilize. Those who were once enthusiastic may temper expectations as complexity and regulation increase. This adaptability is itself a signal of mastery. Opinions are tools, not identities. When facts change, they change their minds without apology. The deeper lesson for observers is subtle, but profound. Financial celebrities are not trying to be right about crypto. They are trying to remain solvent, relevant, and flexible as the financial landscape shifts. Crypto in this light is neither enemy nor savior. It is a stress test, forcing long-standing assumptions about money, trust, and authority into the open. How one responds to that stress test reveals more about their philosophy than about the asset itself. And so the conversation resolves not with a verdict, but with a posture. Curiosity without intoxication. Skepticism without dismissal. Engagement without overexposure. This posture, refined over decades of cycles, is what allows financial celebrities to navigate crypto without being consumed by it or blind to its implications. They stand slightly apart, watching carefully, participating selectively, and remaining ready to adapt if reality demands it. If this exploration has clarified how seasoned investors think about cryptocurrency beyond the headlines, I invite you to subscribe to the channel and continue these long-form reflections together, and leave a comment sharing whether this perspective changed how you interpret public opinions versus actual behavior in markets. Because understanding the gap between words and actions is one of the most valuable skills an investor can develop.